You closed a deal recently. Talk to me a little bit about what the deal was.
They were expecting to get to about, 130 million, and we sold them for 240 million after a year. So I've been doing this for 30 years. You kind of develop an intuition for where you can take a business. 12 million of EBITDA because of increased revenue and increased profitability to a run rate of 25 million in 6 months. Do not sell when the owner is ready. Sell when the business is ready.
Devesh, pleasure to have you on, man.
Same here, DJ. Great
All
to
right,
be here.
set the stage for us. You closed a deal recently. Talk to me a little bit about what the deal was, where the business was at when you came to them. Just set the stage.
So we very successfully closed a deal like about 2 weeks ago. And it was a very interesting process because the owners had tried to sell the business a year ago, and they didn't get the price they wanted. They wanted 130 million, and they were getting 90. And the business is a food processing, manufacturing business. 110 people. They've been there for over 20 years, and they were at their wits' end as to how to get to the price that they wanted. So they called me in. I worked with them for a year. And so they were expecting to get to about, 130 million. And we sold them for 240 million after a year.
Wow. From 90 million to 240 million in
one year. Yes.
Wow.
Yeah.
And what were some of the things that I guess were suppressing the value? Because obviously you were able to more than double the valuation. What are a few key things that you think were holding them back in terms of the amount of money that they were able to get for their business?
Well, the first thing is they had the wrong buyer. They did like a single buyer process. The second thing is there was a huge owner dependency, especially in sales. And they had nobody behind the owner on the sales side. And the third thing was their numbers were kind of flat. So, there wasn't like really growth that was visible in the business. They had been very steady in their performance, which is good. But, there wasn't like a visible growth path when they were doing the process.
Got it. So those are a few key things that you were able to see kind of from day one.
Yeah.
And what did that conversation look like? You meet with the business owners. Obviously, they're unhappy. They weren't getting the type of value that they wanted for the company they spent their lives building. Just kind of paint the picture of, that initial conversation.
So I've been doing this for 30 years. So, you kind of develop an intuition for where you can take a business. So when I arrived the first day, I toured the facilities, talked with them, and as somebody who does that very frequently, the first thing you look at is the management team. How solid are they and what depth they have? And there it was clear that, having just one of the owners running sales and nobody with him, that was a glaring issue. The second thing, walking through their facilities and looking at how they were running it, I could figure out that they had a lot of available capacity that they were not using. And the layout was okay, but not great, especially how they were doing the logistic flow throughout the whole plant. So I told them day one, I told them, I think we can sell this business for 230 million, but it's going to take some work. And they were like, what are you going to do? And I'm like, I don't know. Because the problem is you get that feeling, you know where it can go, but how you're going to get there precisely, that's what happens in the first, 2-3 weeks, really digging into the details and figuring it out.
And getting into the weeds.
Exactly.
Wow. So I would imagine that they kind of thought that was bullshit.
They
right?
thought it was completely impossible.
When you said that, they'd been running the business for that long. For someone externally to come outside who doesn't know the business, what was their initial reaction? Did they?
Incredulity and but because they were like very serious about trying to do it, they were like, "What the hell? Let's do it."
Right.
So it was really like that.
And who were they to sell the business originally? Were they working with another investment banker? Or
Yeah. They were working with another investment banker. And by the way, that investment banker still had them under contract. So we had to fire the guy. So that turned into a ugly situation, actually, because, he wanted a breakup fee and this and that. And we're like, you didn't do your job. So, but got rid of him.
So what are some of the differences in what you actually came in and did for this business than a traditional normal investment banker would do to drive value and drive up the sales price to the level that you did?
A traditional investment banker is going to follow a very simple process. They're going to sit down with the owners. They're going to prepare an overview of the business and prepare the owners for a conversation with the buyers, but it's going to stop at that. Whereas when given the time, so what I did with this business is the first thing we did was hire a new person to manage sales. And the key there was the previous owner who was doing sales, he had grown up with the business. So the kind of buyers he knew and that he was very comfortable with are small buyers. Whereas we brought somebody who was very comfortable with multi-billion-dollar companies, key accounts that he had been selling to for a long time. And within a month of him arriving, we landed a contract that was larger than any other account they had until then. So that was a key difference. And what that gentleman brought also is a pipeline of those deals over the period of time, because he knew how to go and sell to those businesses. And there's a difference because they have quality requirements. They have very strict standards in terms of delivery times and, being able to see where their order is and all that. So they use EDI. They want to have clarity on the schedules and all that, which they were not used to. So that's what had to be built also in parallel.
So it sounds like you came in and you were able to add some top-line revenue through recruiting. You were able to go and bring in a person who could scale the top line and show that the business was trending upwards in terms of revenue growth.
Exactly.
And then I believe you did some other things within the operations to also increase profitability. Can you talk a little bit about that?
Certainly. So that takes a little bit longer. So one of the things that we did was relocate the warehouse to simplify the flow throughout the plant. And more importantly, precisely measured how much available capacity we had at every station. And so, like you find in any plant, there's one bottleneck always. But even that piece of equipment that was the bottleneck, they weren't really using it at full capacity. So that was the first thing we did, is just turn it on. Just like run it 24/7, as much as you can. So that allowed to have more available product. And then what we did was get full clarity throughout the whole plant. So basically, the salespeople could see how much available capacity of what type of product was there. And basically, they could focus on selling that.
So they could sell the full capacity of what was available.
Of what was available. And the manufacturing guys could see what the salespeople were selling, obviously, but they also knew, what other things they had. And what we implemented was run everything until the point where it becomes differentiated to just one customer. So get it to the maximum level of production possible before, if you are selling like flour, it depends on how fine the flour needs to be for a given customer or what other additive the customer wants in it. So you just stop before that point. So that allowed to also have more capability for flexibility between different orders. And finally, the manufacturing people could see what potentially the purchasing guys could buy that was not on order but available. And so buy it on an opportunistic basis at lower prices than, when you actually really, really have to buy it.
Right.
So all of that took about 6 months to implement dashboards all across the value chain and give the tools to the sales and purchasing people to see that information, provide that information, and for everybody to know how to manage that information. The results were spectacular. Within 6 months, without changing sales price or input price, we were able to drop 5% of the revenue down to the bottom line. So so they went from about 12 million of EBITDA because of increased revenue and increased profitability to a run rate of 25 million in EBITDA within 6 months. And one of the things that I always say is, do not sell when the owner is ready, sell when the business is ready. And that is a mistake that many sellers make, is just rush to market and they're desperate to sell.
That's pretty incredible. I mean, pretty much doubling the profit or EBITDA within the company within a 6-month period.
Yeah.
Not a lot of people can do that. What are some things in your background and your experience that have led to your ability to look at the operations of a business and, double the margins on a pretty consistent basis?
So I used to work at Bosch, the German conglomerate, so $90 billion in revenue. And I was head of strategy and mergers and acquisitions for North and South America, reporting to the board. And we were buying 50 to 60 companies a year. Now, Bosch has very high quality standards with nearly 95% of the products are at a Six Sigma level, so 1 part per million failure in the field, not in the plants, but in the field. So when you're buying a company that's, say, $100 million in revenue, they are usually at a 3 to 4 Sigma level, so they have like 400,000 problems per million parts, so 40%. And there's no way you can buy a company like that and integrate it in an operation that's so much better tuned. So my job was also not only to buy the company, but also incubate it for about 6 months and work with them. And usually I would do the same kind of things that I did with this client, which is, by the time I was done with them, their margins went usually from 10% to about 20% net income, and their revenue was growing at 20%. But my philosophy has always been, you're not trying to implement a full system. You're looking at the top 3 or 4 areas that you can, act upon, and within 6 months change the trajectory of the business. And it always starts actually with the management team, because it's the capabilities of the management team that eventually drive the capability of a business.
That's fantastic. Okay, so let's go back to the actual deal.
Right.
I wanted to give some context on, how that's even possible, because that probably sounds a bit ridiculous to be able to double the profitability of a company that's been around for how long? How many years?
20 years.
20 years.
Yes.
Within a 6-month period. But let's go back to the deal. So you're able to make strategic implementations into the management team, adding in a sales guy, growing top line revenue, increase in margins, kind of telling a story of the growth of the business.
Right.
And then after that 6-month period of making those changes, it sounded like you did another 6 months of just kind of allowing those results to tell the story explain where to go from there.
So what we did also is we built a business plan that was clearly showing the path to further increases in profitability. And now they had a backlog and an increasing backlog of orders from those larger customers. And there was a clear plan on how to land more of those multi-billion-dollar customers. So you had a very credible path, because the other thing that you see quite often is a business that's had a flat performance, but then they put together a business plan that shows a hockey stick going forward, which makes it very difficult when you're trying to sell, because then the buyer is going to say, that will be based on an earnout.
Right.
We will pay you when we see it. If we don't see it, you don't get the money. I mean, and I understand. I would do the same thing. It's a little bit harder when there's a very tangible plan, very defined with clear milestones, action items, and you can show the progress, like you're getting qualified to a large customer through their quality standards, and they're coming in and auditing, and they're running test batches and all that. So it becomes a whole lot more credible that you're actually on the path. You're like, a couple of months away from landing that customer. So there was that, but the whole plan was also on the operational side, how to tweak the equipment that was the bottleneck and increase the capacity. And we had started buying the equipment to, allow for that. So there was a very credible 3-year plan that showed a clear path to even further profitability. I also identified 3 other companies that were in their area of business, and so they were about $120 million in revenue, and I identified 2 or 3 businesses that were like in the $5 to $10 million in revenue, and we started negotiations to buy those companies, to acquire them. And they were very targeted in terms of allowing entrance into further products and enhancing the purchasing capability, because some of them had access to some growers and other suppliers. So there was also that path, which kind of showed a further potential to increase the value and the size of the business. The third part was finding the right buyer. And what that means, you will always have, with those kind of businesses, above $10 million in EBITDA, a lot of private equity players are going to be interested. But strategics can pay more than private equity people. So if you're able to identify and bring in a strategic, the conversation changes. So when we got the first series of bids, the strategic was at $220 million, and everybody was behind.
Right.
So then you can go back to the other players and say, you need to sharpen your pencils because you're like not in the ballpark. And so it took a month of doing that process, and the final bid was actually from a PE firm, was $240 million. And the other thing also that we did during that 6 months period was what's called a quality of earnings. So basically an audit from an outside firm looking at your numbers and saying, what were issues, if any, and they did find something where the valuation of the inventory wasn't quite right. We fixed it. But then we had that audit that we could show to the buyer, so that increases the confidence that the results that we're talking about, we'd actually achieve them. And they were solid. The financials were clear. So all that preparation and handling of the preparation for the sale from a investment banking perspective also meant that the process went pretty fast. We were able to close the deal in 45 days.
Wow.
Usually, between due diligence and the process, it's more like 90 to 120 days. But because things were prepared, were clean, we had prepared the data room, we had prepared everything, lawyers had reviewed all the contracts, cleaned up everything, it was very easy for the buyer to be able to do their due diligence.
We've got 2 questions. So
Yes.
One, it sounds like, considering your previous experience working in a large strategic, like Bosch, where you're buying 50 to 60 businesses, you probably have some unique insights into the mindset of a strategic and how you can position a business to be attractive to them. And so that's one kind of question that I want you to, it's not a question, it's kind of a statement, but I'd love to get your elaboration on just your understanding of those types of buyers and how you're able to position businesses differently to different types of buyers.
So that's a very good question, because it's not just about finding a strategic, but also understanding what value the business you're selling brings to the strategic. So, and positioning it that way when you approach the strategic buyer. Because Sometimes, so in this case, they had operations in the U.S., but they were based in Europe. But they did not have that product line, but they already had access to some of the very large customers. So for them, it was a great business to buy because they could immediately plop it into their own customers and logistics and all that. So they were reducing cost on the logistics side because at $100 million, your logistics are more expensive than a multi-billion-dollar company, and they had access to customers. So it was a win-win. They could increase the revenues and decrease the cost. So it was very clear what value it was adding to them. So when I'm looking for a strategic, I'm also trying to understand what value. It's not just about approaching any strategic willy-nilly. It's really focusing on how much value is this going to generate for them, and internally kind of coming up with a valuation based on that, because then I know if their offer makes sense and if they are truly considering the value of that business, which is how they got them to $220 million to start with. Is because I knew that, and I clearly showed to them what I thought that business would be worth to them, and they agreed. So yeah, knowing how a strategic looks at a company and how they buy it, I don't think so. That's an experience that most investment bankers don't have.
Right, I would say so. One thing that's funny is kind of the psychology of you being on the buy side versus the sell side, because it sounds like what you're saying is you're able to get in the mind of a strategic, look at their operations, understand where this acquisition can, like you said, decrease their costs, increase their revenue, and add almost like extra value outside of even just the financial value of the company. So you're pricing that value in for like future value that they can create from this acquisition. But I'm sure as a buyer, you're not trying to price in that futuristic value.
No.
That's just an observation I had. But so back to the deal, you're able to spend 6 months improving the operations, growing the sales, building kind of a compelling story around the business of where it's going, a business plan that this buyer can take and actually implement to ongoingly increase the value of the business. Then you're going to go targeted to find the right buyers who you feel could pay the most amount of money. You're getting all those buyers into a process, getting them to put bids in for the business. Is there anything else, like any other key details of the deal that kind of had an impact on your ability to close it fast, at over double the original valuation?
So the other key difference compared to other investment bankers is how you structure the LOI. So when they're supposed to submit their bids, I had clear definitions in there of what the definitions of working capital were going to be, how we were calculating EBITDA and key metrics. The purpose there is that there is no misunderstanding and no room for misinterpretation down the road. And that is something that I've seen as a seller, that some private equity players will try to retrade the deal down. And so it starts with your financials are not clean. And that's where, when you have a QOV, there's no discussion about whether the financials are clean or not. If there's a clear definition of what is included in the working capital, then there's no discussion about the valuation of that working capital down the line. So it's preparing the letter of intent, all the clauses in there to avoid any further negotiations during the due diligence. That's a critical step that most investment bankers frankly miss.
Got it. So go a little bit deeper. So imagine I'm a seller in this scenario. Where are sellers making mistakes in that LOI phase? Like, are they just jumping into that process too quickly without the proper preparation to, like you said, have all of these things in the LOI? Mm-hmm. Like, just explain that a little bit deeper.
In my experience, so first, most sellers have not done a quality of earnings prior to starting a process. So that's one thing. The second thing is they don't think about what are the terms and conditions that allow a private equity firm to renegotiate a deal after the submission of the LOI. If your working capital definition is not clear, they can take things in or out and decrease what they say is the value of the inventory. I mean, these are the two key areas, because they'll say your EBITDA is lower than what you're stating because we found this or that mistake when we went through your financials. So that's typically the two areas. So it's not, as I said, it's not just putting those clauses very clearly, how do we calculate EBITDA? And what I mean by that is you go down to the general ledger and list the accounts that come to give that number and that result. And most people just, write inventories. And it's like, no. It's this general ledger, this. I mean, and inventory includes, those 16 accounts. Because then what happens is there's going to be a recalculation of the value of the inventory or the EBITDA at the closing date. And if these terms are not clearly defined, there's room for interpretation. But if they're clearly defined, it's just mathematical. These are the 16 accounts. You add them up. This is the new value of the inventory at the date of the close, and that's the adjustment. That's it. So that's the part that is often missed, and it takes a little bit of preparation to be able to tell the buyers this is the terms that we need to see. Yeah.
Right. And then so it sounds like a lot of times, companies, sellers, they get really excited about an LOI, and then that's not, they're expecting a number that's different to what they end up getting because it gets retraded.
Right.
They go into diligence and they're like knocking off the valuation here, and here. So
well, there's that, and then they're putting in earnouts, and so if you have, because they're going to say your projections are unrealistic, so the cash that you're going to get at close it gets decreased, substantially. And in my experience, about in 70% of the cases, there's retrades between the LOI and the final number. Wow.
And you would say kind of your experience as a buyer, having done hundreds of transactions,
yep.
you already understand the objections and how a buyer's going to view it,
of course,
and all of the things that they're going to do to discount your valuation. So when you're on the sell side, you're just basically pre-handling all of that, like you said, at the LOI stage, so that the negotiations moving forward past the LOI, you're able to hold the value of what
exactly
you kind of agreed upon with the buyer.
Right.
Super interesting. The recent deal. We have some things that we're working on together that I'd kind of love to discuss outside of that deal because, as we saw in that deal, the seller, if they wouldn't have worked with someone like yourself or put themselves in a position of, not only improving their business and selling their business when it was ready to sell versus when they wanted to sell it, getting in front of the right buyers, preparing everything so that they're not going to get retraded and doing all the things that we just discussed. What are some kind of issues with the traditional M&A process that you've seen? I'd love you to talk about that a little bit, and then kind of like what we're building to mitigate that and kind of change the way things are done.
So traditional investment bankers grow up in an investment bank. So that drives them to follow a process which has been codified over decades and which really relies on just taking a business as it is and preparing some information about it, and then doing a process where they reach out to a vast number of potential buyers, bring in some people, and then have the LOI, then do due diligence. But during all that, they're not really truly advising that much the seller. And the seller doesn't really get to understand the buyers either, because first, they have no experience of the process, and they misunderstand how important it is also to have a clear understanding of the buyer and what is it that the buyer intends to do with their business, if anything. And so what we are doing together is completely turning that process on its head. It's connecting the buyer and the seller very early and explaining to the seller what it is that is going to happen with the buyer. I was just having a conversation yesterday with a gentleman who has an electrical business, and even before we introduce him to a buyer, I went and explained to him what kind of buyer it was, what to expect during the process, and so really help the seller a whole lot more during that process.
Got it. And due to your experience, you're able to advise on different types of buyers, strategics, what they're going to be looking at, and how to position that business for a strategic versus a private equity guy versus a family office. Maybe you can talk a little bit about what we're doing overall with the company that we're building and how we're kind of removing the friction on both the sell and the buy side, and what are some of the benefits to sellers that we work with, and then what are some benefits to buyers. And, because I feel like in the traditional M&A process, you have buy side guys and you have sell side guys, and they're competing with each other,
right,
where the sell side guys are in opposition and they're working for the sellers and they're against buyers, and the buy side guys, it's the same, it's opposition. And so maybe you can talk a little bit about how what we're building benefits both sides and kind of removes a lot of friction in the overall M&A process.
So in the first thing is our services to the seller are completely free, and we are taking very seriously at heart their interest and guiding them much more than I would say a traditional investment banker would, and because and we're not costing them anything. Whereas an investment banker, traditionally will take anywhere between 4 to 6% of the deal value, and that's on the sell side. And on the buy side, it'll be something similar. It's going to be between 2 to 3% at a minimum, if not more. So the fees that are baked into the current process, I compare them with what happens in real estate. You have a buyer and a seller agent, and each of them is getting about 3%, and so it's 6%. So first, we cost a whole lot less, and there's a whole lot less friction because we're not putting all the onus on the seller to prepare all the documents and go through all that. We know what are the things that are important and get that done. And then we bring them the right buyer based on what they want. And the buyer is the one who pays us the fee. And so it's much cleaner. And there is no process as in the traditional sense of the word. It really becomes a dialogue between a buyer and a seller. So they get to know one another a whole lot better and understand one another better. Then there's no pressure on either side.
Wonderful. Yeah, I would say it's interesting because considering we are making introductions between the buyer and the seller earlier on in a process, yeah, I feel like it allows a lot of wasted time and just friction to just be completely removed. Because right, if you make an introduction and a buyer talks to a seller, they can kind of yes or no instantaneously, exactly, yep, versus whereas a business owner, when you're running an operation and you go into either one, a public process where your business gets listed publicly and then everyone can see it, your employees can see it, your competitors can see it, your entire operation can get kind of
very
vulnerable, and then it can just really mess up things when you're trying to keep momentum in the business.
Right.
But if you have confidential conversations where you can get in front of qualified buyers who are well capitalized and could actually buy your business, one, it allows you to get a quicker understanding of what your business could actually be worth versus some broker or investment banker's kind of theoretical valuation. Yeah. Is there anything you would add to that?
A couple of things. The first one is most transactions don't happen. So a business owner is going to talk with a broker or an investment banker. They're going to do a process, but the process fails. In about half of the time it fails because they are not able to bring the right buyers. And so it's very frustrating for the business owner. We can bring the right buyers. The second thing is the red flag is, the broker or the investment banker is not advising them in how the structure of the earnout or seller's note or these kind of things, what the financial impact is. And in my experience, especially with earnouts, 70% of them, they never see $1 out of that earnout clause. And that can be like 20%.
Wait, let's back up there. You said what percentage don't see a dollar from the earnout?
70%.
70%.
Yes.
Wow.
So it becomes a trap for the seller. If there's a seller's note, if there's a problem and the business is not managed well after the sale, their note is at risk also. So there's all sorts of clauses like that I feel in the traditional process are not explained well enough and taken care of during the process. And we avoid that for the seller.
Yeah. So it sounds like for a lot of sellers, they're at risk due to a lack of knowledge of they haven't sold a business before. Maybe they have a couple times, but they haven't done hundreds of transactions. So there's certain things where in the actual deal structure, because there can be a number, but the number doesn't always tell the full story because the structure of the deal is what actually determines what amount of cash you're actually going to realize. Because like you said, 70% of earnouts, they don't see a dollar. I mean, that's even something that I wasn't aware of. That's quite concerning.
Yes.
Maybe talk to me, what are some things you can do to prevent, so if an earnout is going to be in the deal structure, how can you protect yourself and make sure that you actually realize that cash? Are you trying to avoid earnouts entirely? Are there ways to structure them that, you're more protected? Maybe talk about that a little bit.
So the first thing is, if possible, I would avoid an earnout. And earnouts happen when a buyer is not confident in the projections of the business. But if you show how solid those are and that it's grounded in reality, it makes it much easier to decrease the amount of the earnout. So that's number one. The second thing is, do not base an earnout on EBITDA, because a buyer, after they have bought the company, they're going to add expenses to it. So it will reduce the profitability of the company. So if possible, it should be linked to either a revenue number or a gross margin number, but not something where the profitability or the number can be influenced by the buyer after the transaction. Or at least, avoid the get to numbers that are much harder to fudge. So revenue is the best.
So it sounds like a major risk is having things within the purchase agreement that could, be at risk of you actually realizing the cash down the line. What are some other things just to look out for overall when working with like a traditional business broker or investment banker?
So the traditional business broker or investment banker are not really going to vet the buyer. And so you end up with buyers that are just not qualified. They don't have the money. They are, independent sponsors that try to kind of hold you hostage while they're trying to go out and raise money.
Right.
And others have like very little cash and they rely on a SBA loan to close the transaction. And, so there's, for all those reasons that they bring unqualified buyers to the table, they just waste everybody's time. And, but, sometimes they have retainers, so time is not really an issue for a broker or for an investment banker. And not only are they costing the seller money, but also the time that they're spending talking with unqualified buyers.
Right. While trying to run their business.
Yeah.
So what do we do differently in terms of qualifying our buyers, and what type of buyers do we actually target for the business owners that we work with?
So we target well-funded PE firms that actually have the cash and the interest in that area, that industry. So we know what kind of deals they do. We know that they have the money, and that if they show up at the table, they will actually close the deal. So that's a big certainty. And we also know what kind of clauses they've done. I have spent so much time working in this industry. You end up knowing a lot of those people who are the trustworthy ones and which are the ones that you should avoid.
So you kind of know not only if a buyer can actually pay and can actually close a transaction based on, how well capitalized they are, previous deals they've done, do they actually know the industry,
right,
those types of things. And then you also know what to look out for, because you hear the horror stories of private equity and what they do to companies and everything like that, but which ones are, the ones with integrity and
Right.
that, can close transactions and actually create value in the businesses. And we obviously try to bring those types of buyers to the table. And maybe we could talk a little bit about anyone outside of private equity that we're bringing is typically going to be like a family office
Right.
or someone that's very well capitalized that may not have an equity fund, but has proven to close transactions and is not going to waste, any of our sellers' time.
And with those type of buyers, there I would actually recommend that you roll over some equity because those buyers are serious and they will add value to your business so that if you keep like a 20% or a 30% stake in your company, a little bit further down the road, you will get usually about as much cash as what you got for 70% of your business. So these are also things that we can guide our sellers towards.
Right. If you're going to sell, say, a platform company to a PE group who's proven to be able to take companies from where you're at to where you want to go, you're someone who can kind of vet and speak with the seller and advise on, hey, how should you structure this deal?
Right.
If you want to stay on, post-close, what does that need to look like? And what are you looking for out of it? Things like that, maybe a traditional investment banker who's never sold a company themselves or,
negotiated those terms or managed a second exit would not know to properly structure.
Right. Well, Devesh, thank you so much. Thanks for your time.
It's a pleasure, DJ.
We'll be doing this again soon.
I look forward to it.